Hello and welcome to Market Domination. I'm Josh Lipton, live from our NYC headquarters. Just an hour to go until the closing bell, and stocks are slightly higher here as Wall Street braces for a turbulent week ahead as renewed trade tensions have added more uncertainty ahead of a key inflation report and the first wave of second quarter earnings. Let's welcome in now. We got Thomas Hayes, Great Hill Capital Chairman and Managing Member, as well as Yahoo Finance's very own Ben Worschel and Jared Blickery, who are all joining us throughout the show to break down the headlines. Ben, kick us off where Trump's latest deal stand with our top trained partners here.
Yeah. Here in Washington, even it's a very Russia-focused day, but we still have a lot of tariff headlines there, specifically around Russia. So what President Trump announced earlier today was that the bottom line of plans to have very serious economic consequences if he can't end the war between Russia and Ukraine, what he described as very severe secondary tariffs on Russia and its trading partners. There's some confusion here in Washington over the details of this. Howard Lutnick talked to reporters afterwards and said this could take the form of tariffs or sanctions. And CNN is reporting that what Trump actually meant was 100% tariffs on Russia itself and then secondary sanctions on Russian oil. Either way, it's a sort of focus on the economic side of this Russia-Ukraine war that is clearly frustrating Trump. He expressed over and over again today his frustration with Vladimir Putin, frustration with the fact that this war is not going on. And so we now have this new 50-day deadline, which gets us to the end of the summer, where Trump is trying to end this war, or in one form or another, a lot of economic pressure is coming. And as you mentioned, there's a lot of other tariff headlines. I'll just mention one real quickly, which is Europe. There's a lot of back and forth there today. But talks with Europe are continuing after Trump's announcement of a 30% tariff over the weekend there. A lot of optimism on both sides that the talks are at least going to continue, and that's yet another deadline here on August 1st.
Ben, let's say Trump really followed through with this. I am just curious, how do you think Moscow would or could, not just Moscow, but also Moscow and its trading partners, how could they respond to that, Ben?
Yeah, I think it's a big question is exactly the form that this would take. I do think the oil piece of this is clearly the most significant one way or another, whatever form it takes. John McCain very famously called Russia a gas station masquerading as a country. And I think that's where you're going to see a lot of reaction here if Trump is serious about following through here. The big consumers of Russian oil maintain to this day India, China, Europe, countries like that. So that's the part where is clearly what Trump, I think, is aiming for as a leverage point, and where you're going to see a lot of attention from world capitals, not just in Moscow. The big question you kind of alluded to there is whether Vladimir Putin is changing his position at all on this because of this new threat. That's very unclear. But clearly, if you're in India right now, which is very dependent on Russian oil, you're watching this closely.
Tom, I want to get your thoughts on these latest Trump threats as well, which, by the way, again, Tom, I'm just looking here, the popular average is kind of just shrugging this off.
Yeah, I mean, Trump's negotiation strategy has been punch him in the face and then offer them an ice pack, and they're grateful for the ice pack. So what the market knows is that he goes for all, and then when they come to the table, he talks with them. But if they don't respect his deadlines, he will pull the trigger on the tariffs, which he has. And we saw that in June, $27 billion, record amount of money into the treasuries. And we actually ran a budget surplus in June to the equivalent tune of $27 billion. Spending went down. So I think that Trump's showing a little bit of momentum, and the market's comfortable that he's also shown in recent months more rationality. Comes out strong, and then he backs up into something that's reasonable and the markets can digest.
Jared, great to have you back, by the way, over at the Interactive. How have investors been trained today to kick off this week?
Well, the net result is stocks are up right now, although they started in red territory, but not a lot of movement here. And despite this latest punch in the face to the markets, potentially over the weekend, we are just not seeing a big reaction. 3 months ago, you would have seen the markets down several percentage points. But here's the Dow. So we started out slightly in red territory, and now we are up a whopping 87 points, so not even triple digits just yet. Here's the NASDAQ up a little bit more, about 1/3%, and it's been the small caps leading today. Those are up about 0.5%. But let me just show you the VIX volatility index real quickly here. Still holding under 20. That's a big psychological level. Really not a lot of movement despite the big numbers that you might be seeing in some of these headlines right now. I do want to show you one market that is a little bit concerning for me. That is the 30-year T-bond yield. That is approaching 5% yet once again. And let me just show you the year-to-date chart. It has been here before a few times. Here's one where it slightly exceeded that 5% level. There's another one at the beginning of the year. Each time it backed off, but if you'll notice, the retracements here are getting a little bit more shallow each time. So sometimes when we see that market, the 30-year T-bill, approach these levels, we do see stocks sell off. Just not really seeing a lot of that today. I want to talk about crude oil. We were just talking about that. Let me show you the year-to-date because it's down about 2% right now. And you can see it's down 8.4%. Here were the fireworks that we saw in June, but nevertheless, prices are remaining depressed here. And we're going to see this show up in the sector action today as well. This is crypto. We'll come back to that in a second. But here's the sector action, and here's energy at the bottom of the pack, down about 1%. In the pole position, we got communication services. That is thanks to Alphabet, as well as also Meta and also Netflix. Then we have financials. We can talk about that a little bit later. Industrials riding high. But basically, the defensive sectors all along the bottom here, those are the ones that are lagging. And so that's what you want to see in a bull market. And speaking of bulls, let me just show you the NASDAQ real quickly. Not seeing the most love from the mega caps right now, and that trilogy there, NVIDIA, Apple, Microsoft, each of those down. Apple the most, down 1%. But for the most part, we're seeing a lot more green than red. And so that's what you want to see in these bull markets.
And Jared, we did see Bitcoin hit some new highs to start the week. So where do we stand now?
We are still holding, and let me just get the exact number for you, 119,824. We're briefly above 123,000. You can see that point right there. That was in the middle of the night. We are off of those highs, but let me just show you what's happening with Ethereum as well. That finally broke recently above 3,000. It is back just below that number. But really the tell for me in a crypto bull market, what you want to see is breadth. I'm going to sort by performance here, and I'm going to show you what has happened over the last 10 days. You can see a lot of these markets up more than double digits. Here we have Stellar, that's up almost 100% in the last 10 days. We got Algo, we also have Ripple ripping, that's up 32%. Cardano just behind it, even Dogecoin up 20%. So in the crypto market, we are seeing a lot of breadth, and that's also what you want to see in a bull market.
Tom, your thoughts broadly on the markets here. You know, as Jared was mentioning there, I mean, you look at the popular averages. Right now, we're edging higher here in today's trade. Got a big week, though. Got a key inflation report. We got bank earnings on tap. What do you expect? Where do you stand on the rally?
I think that overbought can remain overbought. The one thing I've learned in this business, seeing these V-shaped recoveries, is that overbought can push higher because so many people were caught off sides at the lows that retail was buying the lows. Institutions now have to play catch up. And where are they going to catch up is those stocks that haven't left the station. So that you're going to see a broadening participation in not just the Mag 7, but broadening out as we've seen in the beginning parts of the second half. And then as it relates to earnings, the secret to happiness is low expectations. And that's what's happening for earnings season. Estimates for earnings growth down to 4.8% from 9.4%. So it's an easy bar. You don't have to jump over it. You can just step over it.
We'll turn to another top story today. Fed Chair Jerome Powell continues to face pressure from President Donald Trump and the White House. This one is interesting, Tom, and I'm very curious to get your takes because this is being talked about a lot today. Big picture, you know Trump, listen, his feelings on Jay Powell, I think we can all agree, they're fairly well understood at this point. Not a fan, he's upset, he's frustrated, he thinks the Fed's late, they should have been already cutting. Now you hear all this hot talk and chatter, which I'm sure you've been reading about. The Fed's building renovation, It's gone over. That's where the focus is at. Yeah. It feels like we've kind of turned a corner here in terms of the heat being ratcheted up. Yeah. And I'm just curious what you make of that.
Yeah, there's no question. Look, taxpayers like you and me are paying $600 billion of extra interest that we don't need to. The rate is not neutral. There was a Fed head out today saying we're close to the neutral rate. I mean, I could go to my 11-year-old who's in fifth grade and say, our Fed funds rate is at 4.25 and inflation is at 2 and change. Does that look neutral to you? And she would say, no, that looks pretty far apart, like you could drive a truck through it. So number one, we're paying more than we have to. Number two, millennials are getting hurt more than anyone else. 72 million people in this country trying to start families, trying to buy a house, housing and family formation. They've been delayed by 5 years. And the only way we're going to get out of this situation, 120% debt to GDP, we're not going to cut our way to prosperity. We got to grow our way like we did in the 50s when we brought inflation, debt to GDP from 120% down to 63%. We ran inflation a little bit higher than normal, 3 to 5%. We ran nominal growth much higher. And that's going to be the formula moving forward. And that's why the big, beautiful bill, we're seeing the tax cuts, accelerated depreciation for small business. That's job creation stuff like we saw in the first term of Trump. And honestly, Main Street did much better during the first term of Trump than Wall Street did. And I think you're seeing policies, we've gone from tariffs and war and geopolitical to now tax cuts, growth. And the third piece that people are awaiting, which is going to be huge, is going to be deregulation. That's going to let animal spirits go. So what Trump is saying, look, if they got to get him out on a technicality, did he lie in front of Congress, did he not? The fact of the matter is the only building that they redid from the ground up was the FBI building. That cost less than the overrun. That cost $700 million. This was estimated at $1.8 billion. Now it's $2.5 billion. Who's putting some restraints on this independent body in terms of spending?
Don't you think, though, that when I read about this building project, which has been known for years, and the overruns are public, to me, I read this and I say, okay, I see it as like, this is really just about Trump being frustrated with all the things you're laying out that he's not cutting. That's how I read it.
Yeah, well, 100%. Look, if you got $1 trillion of interest expense and it could be $500 billion, that's some serious math. And Trump has spent his whole career refinancing debt, and he likes to do it at low rates. So
he's a real estate guy. He wants it low.
And look, the fact of the matter is, let's say Powell's he's supposed to be data dependent. Now he's become prediction dependent. Let's say his predictions are correct and inflation goes up. It's much easier to re-raise rates by 25 basis points than to try to fend off deflation, which costs a lot, puts a lot of people out of work, a lot of pain. You can't turn that around. You can quell inflation if it starts to get away a lot quicker than you can. Tell me
you have to go, but I just want one last question.
Yeah.
I'm curious about your take on this. There is the assumption, Tom, you know this, the assumption and the expectation that we have an independent Fed.
Yes.
To the extent that that ever became really called into question, I'm just curious how you think as an investor the ripple effects of that would be on the dollar, on rates.
Yeah, well, look, I think the other side of it is people are feeling like Jay Powell may not be impartial based on his actions during different periods of his tenure. And to your point, that's concerning to some people on certain sides. And if it became kind of a proxy just for what President Trump wanted to do, maybe that would be concerning as well. But I think consensus is building across lines. People realize that these millennials are getting hurt. People, if you look at people's, insurance bills, if they look at their refinancing rates, if you look at the amount of trapped equity in homes, people can't even access through HELOCs if they want to build an expansion if they're having another kid, they can't do an addition on their house because the cost is too much. People are trapped in houses bigger than they need if they're 60, 70 because they can't trade from a 3% mortgage to a 7%, even if they're taking equity out and moving down. This is unnecessary stuff from a guy who candidly 3 times has been wrong. Autopilot on quantitative tightening, crashing the market 20%, transitory. So his prediction record's not good. And his summary of economic projections, if he's so clear inflation's going to go up, why does he have real GDP at 1.4%? That old dog don't hunt. You can't talk out of both sides of your mouth. Either we're going too fast and you got to keep rates high, or we're going too slow and you got to bring them down. And Trump is saying, bring them down.
All right, Tom. Well, we are just getting started here on Market Domination. Coming up, got CPI data tomorrow set to show just how hard tariffs can impact consumers. We're going to speak to an expert and tell you everything you need to know ahead of that report. Plus, Bitcoin rallying to a record high as Congress kicked off Crypto Week in Washington, D.C. We discuss what's next for the industry later in the hour. Stick around. Much more Market Domination. That's still to come. That's great. Investors looking to the June CPI report for signs of how earlier rounds of tariffs are impacting prices across the U.S. economy. And Yahoo Finance's Allie Canal has more on what to expect. Allie.
Hey there, Josh. Yeah, consumers' price index for June, it's due bright and early tomorrow morning, and it's expected to come in hotter than the price increases we saw in May. So here are the numbers to look out for tomorrow. Headline inflation is forecast to rise 2.6% year over year. That's up from May's 2.4% increase a month. And then on a month-over-month basis, prices are expected to climb 0.3% compared to a 0.1 uptick that we saw in May. And then if we flip over to core inflation, this strips out volatile food and energy categories. Prices are expected to rise 2.9% annually. That is slightly above May's 2.8. And then similar to the estimates for the headline numbers, monthly core CPI expected to accelerate to a 0.3 gain, up from 0.1 in May. Now, heading into this report, President Trump has ramped up his tariff agenda, threatening new duties ranging from 20 to 50% on goods from many U.S. trading partners. That includes Canada, Mexico, even the EU. Now, these tariffs are set to be implemented on August 1st, and this would be on top of the baseline tariffs that have already been in place. And it's those levies that economists say may finally be showing up in the data here, especially in core goods like used cars and apparel, which had kept May's numbers relatively cool. Wells Fargo economist Sarah House warned it's getting harder for businesses to absorb some of these import costs. She called the next 3 months a, quote, key stretch for inflation data. Still, though, the impact is expected to be modest, at least initially, with House describing any tariff-driven price increases as a bump, not a spike. Now, others on Wall Street share that view. Goldman Sachs, for example, still expects inflation to moderate later this year as housing and labor market pressures ease. So just a crucial moment for this data to arrive, especially as we head into earnings season. And of course, this will play directly into the Fed's thinking as well, with that July policy meeting now just about 2 weeks away. Markets still expect the Fed to hold rates steady this month, but they are pricing in a possible cut as soon as September, whereas the Fed itself remains mostly divided here, Josh.
All right, thank you, Allie. Well, for more on what to expect from the crucial CPI data on Tuesday, let's welcome in now Jose Torres, Interactive Brokers senior economist. Jose, let's start with that June CPI report. Jose, all eyes on this report. What do you expect to see?
Well, great to be here. We're expecting a meaningful increase in annualized figures. Headline CPI up to 2.7, core CPI up to 3%. That's based on our IBKR forecast trader participants. You know, the next few months is going to be critical from an inflation data perspective, but during President Trump's first term, we also saw inflation get up to the high 2s, almost to 3%, only to retreat back into the mid 2s. So we're not in dangerous territory from an inflationary perspective per se. In fact, growth is reaccelerating, and when you have growth picking up, you have some of that inflation come with it. So I'm not really worried about inflation in the medium to long term, but here in the short term, we could have some bumpiness, folks.
Jose, you know, when you listen to central bankers, though, our policymakers, you listen to Jay Powell, it's clear they're still trying to figure out, Jose, where the tariffs hit on the value chain. Who pays it? Whether it's the consumer, is it a Jose and Josh? Is it the seller? Is it the producer? Is it all three? They're having trouble figuring that out right now. I'm just curious what you think.
Yeah, I mean, there's definitely a mix. You know, sometimes you have a little bit of margin compression, which isn't terrible all the time. Sometimes you have consumers paying a little more. But again, there's a lot of other things happening too. You have exports. You have momentum on that front. You have capital expenditure momentum as well. You have onshoring progress going on as well. So, you know, overall, you know, I'm not really too worried about the tariffs. Also, Josh, you saw the tariff revenue into the Treasury was quite significant in the month of June. You know, so there's a lot of offsetting factors in terms of who pays for the tariffs. If you have higher revenues, for example, on the fiscal side, and that limits the increase on interest rates, you know, that offers some stimulus in other areas.
Tom, I want to bring you in here. You're listening to Jose. The path he lays out here, both for the June CPI report, but the trajectory of inflation, Tom, does that dovetail with your expectations?
Yeah, I think he's correct. I think, you know, you could have a short-term modest bump, but it rolls over. And by the way, the Fed themselves believes that. If you look at their summary of economic projections, they acknowledge it's kind of a one-time tax. But I will say, if the U.S. consumer was going to eat all of those tariffs, why do you think the foreign countries are fighting so hard against Trump? It's not because they're concerned about the U.S. consumer having a tough time. They're worried about them eating the tariffs. Otherwise, they simply wouldn't care if it was all passed through. So I think we need to keep that in mind. I think it's a balance, like Jose said. And I think, you know, I'd be very interested to hear what Jose thinks about the 10-year yield. Jared was talking about the 30-year yield approaching 5% and kind of what he thinks about the impact of Bessent working on the 10-year yield with the SLR and allowing banks to hold more treasuries, if he has any thoughts there.
Jose, chime in there.
Sure. I mean, I've been saying for a while that folks should be coming in and buying treasuries. You know, the bond vigilantes, I've been seeing them sort of shift and going into more buying behavior at some critical levels. On 2s, we're not there yet anymore, but 4%. Then on 10s, you had 4.5. On 30s, you had that 5% yield. You know, so those important 50 and full round numbers at the 100 have been important buying points for investors. You had strong growth expectations. Inflation projections have been quite subdued. You know, long-term inflation expectations aren't out of control. They're very limited. And then finally, term premiums. You know, those things have run up like crazy. They have to come in, you know, they're extremely elevated. So I think that treasuries are a good buy, and I don't think inflation goes above 3%. So why should the 10-year be at near 450?
Jared, sitting there at the Interactive, my friend. So let's say that June CPI report, Jared, let's say it comes in hotter than expected, hotter than consensus. How might we expect the markets to react?
That's a great insight because the market moves when things get out of expectations. So I went back and I studied the S&P 500, which has been in a bull market since October of 2022, and I looked at the market reactions on each of the days where we had CPI, that's inflation, NFP, that's jobs, and then the Fed, which is the Federal Reserve, those Fed days. And CPI has had the biggest net effect, and you can see it's up 15.2% on those days. And a lot of times you want inflation to come in under expectations to have the stock market go up, and that is precisely what happened most of those events. So the key number to watch, and it's both the same on the headline number and the core number, is 0.3%. That's on the monthly basis. And the last month was 0.1%. So we are expecting a little bit elevated inflation for this month of June, but that's okay. The Fed has been looking for increased inflation, and now it's here potentially, and we'll have to see. If it does exceed those expectations, we could also have some movements in the bond market as well. And I did a similar study on the bond market. So this goes back all the way to October of 2022. Here is how the 10-year yield changed. And you can see it was down a net 42 basis points on inflation numbers. That's 0.42%. And as I was just showing at the top of the hour, the 10-year is at almost 4.5% right now. NFP, that's payrolls, we've seen a net increase, and then the Fed has seen almost a 1 percentage point decrease on those days when they have been in the market, and that's on the 10-year. So with respect to the 30-year, yes, it is approaching 5%, and back a few months ago around Liberation Day, when it was heading above that number, we did, the rally after Liberation Day, we did see some net effects on stocks. They did kind of decline a little bit when we saw those elevated rates. So my bottom line thesis is if the CPI comes in tomorrow at expectations, probably going to see a stock market rally just a little bit. But if it comes in at 0.4, 0.5%, you're going to have that decline. And then we could also see those yields reach some of those critical levels, 4.5% in the 10-year, and then 4% in the, or 5% in the 30-year.
Jose, you know, so we're talking about that CPI report. We also get retail sales this week, another important data point, another window into the consumer. How would you characterize the American consumer right now, Jose? How healthy, how resilient?
Bifurcated. You know, at the upper end, you have the benefits of capital markets that have really driven those expenditures. In the middle end, you're doing great from a labor market perspective in terms of having employment and remaining confident that your job will remain there. Then on the other side, we have continuing claims. Those have been quite elevated. That's a little worrisome. Then at the lower end, we have affordability concerns. Real quick on what Jared said, I think the bar is quite high in tomorrow's CPI numbers in terms of expectations. You know, we're expecting a pretty significant climb. So I think if you have numbers that come in at expectations or even below, I think you can really blow past all-time highs here.
Final question, Jose. I saw this report in the Journal, my friend, and I thought, you know, I gotta ask Jose about this. Survey of economists, his colleagues, all right? Bottom line, here's what they said, Jose, get your take. They said the economic fallout from President Trump's policies may prove less dire than feared. Economists expect stronger growth in job creation, lower risk of recession, and cooler inflation than they did 3 months ago. I'm just curious to get your reaction response to that, Jose.
I agree. I think President Trump's really shown that he's going to be a lot more relaxed. Even today, he really turned around quickly. This is really a long chess match that's being drawn out on the tariff front. As far as the GOP playbook, there's a lot of the traditional policies that the Republican Party likes to bring out. They're very good for growth and they're very good for risk assets. We're talking about reduced taxation, milder regulation, subdued energy costs, and that onshoring progress. I think together it's really a good outlook going forward for equity markets.
Jose, great as always to have you on the show. Thank you, sir.
Thank you. Great to be here.
Coming up, Bitcoin spiked above $122,000 for the first time as investors greet the open of Congress's Crypto Week. We're going to speak to an expert on the other side to discuss what's next for the industry. Stick around. Much more market domination, folks. Bitcoin hitting record highs on Monday, kissing 123,000 before pulling back. For more, we're bringing in now Scott Melker, host of the Wolf of All Streets podcast. Scott, it's good to see you. So Bitcoin keeps moving higher, Scott. I'm curious why you think Bitcoin keeps moving higher. We've had some guests on the show, Scott, and honestly, they've said, let's not overcomplicate this. They'll say this just comes down to strong corporate and institutional demand. It's limited supply. So yes, prices are going to go higher. Keep it simple. Do you agree with that?
I absolutely do. And in fact, that's the answer I was going to give, unprompted. I think everybody searches for a narrative. Human beings need to know why things are happening in markets. In this case, it's very, very transparent. We have record inflows into the Bitcoin spot ETFs, which are the most successful ETFs in history. We have a number of companies very transparently buying Bitcoin for their balance sheets, and there's simply more demand than there is supply. It's not even really an issue of supply being cut in half or being a limited supply asset, which is all great for the long-term use case of Bitcoin. Right now, there's just a lot less sellers than there are buyers, and prices continuing to grind up the wall.
I had Matt Hogan from Bitwise on the show recently, Scott, and I was asking him, okay, where are we headed from here, right? And Matt said, listen, I think we're 200,000 before year end. You agree with that?
It's hard to make determinations on what price will be in the short term, but I definitely think we're going there. Whether it happens in December or March is sort of irrelevant to me, and I think to most of the true believers who own this asset. Matt was on my own show this morning and actually said the same thing. We're close friends. He's one of my favorite advocates for this industry, and Bitwise is doing incredible things. I would be very surprised if we're not in the 150 to 170,000 range at some point this year. But we all know that Bitcoin, like any other asset, will continue to have bear markets and retracements and corrections. So if we go to 170 or 180 and then correct to 120 in December or back at 200 in March, I don't think that makes the prediction incorrect.
Crypto Week in Washington, Scott, what are you watching for there? What's on your radar?
Well, we definitely want to see the Genius Act, which has already passed the Senate, get passed easily in the House and end up on President Trump's desk. We know that that's one of his priorities. And getting clarity on stablecoins really is the lowest hanging fruit for legislators right now. And I think it'll give us much more clarity on what companies can do moving forward. Of course, that's going to be followed by a number of other pieces of crypto legislation that really are important and we need to see action on. Namely, for me, is the Clarity Act, which is the market structure bill that we're looking for. That's going to determine what is and is not a security or a commodity. But more importantly, is also going to lay out the rules of the road for exchanges and other operators in the industry. Can an exchange also be a custodian? Well, they really can't in the legacy market, but they still can in the crypto market. These questions need to be answered, and they really need to be answered soon, because it is very likely that we're going to start focusing on midterms and that there could be, a change from red to blue in either the House or the Senate, and then these things could stall. So now is really the time for legislators who are passionate about this industry to strike while the iron's hot.
Scott, you mentioned Trump there. I'm just curious. I mean, you have a president clearly in a White House and an administration that is crypto friendly. What role, if any, do you think they're playing in this rally?
Well, I think that Trump has been very clearly a crypto-forward president, as you said, and you couldn't have more of a 180-degree change from the previous administration. So I definitely think that has been a huge catalyst. If you look around the administration as a whole, even in all of the leading positions that are unrelated to financial markets, you have Bitcoiners literally across the board. It's like a fever dream for those of us who have been in the industry for so long and have dealt with a contentious government. So at every regulator across the board, we have people who deeply believe in Bitcoin because in this case, they probably have similar values to people who would be Bitcoiners and have gone down the rabbit hole. So I think he's played a tremendous role in setting the road for what is likely to happen for crypto in the country. That said, that also comes with a lot of Trump. So there's a bit of a grift and a bit of controversy that comes with any of that.
Final question, Scott, just to get your take on this. The proliferation of Bitcoin treasury companies, Scott, what do you make of that trend and theme?
Okay, so for me, there's a very important distinction. There's Bitcoin treasury companies, which are companies that financially engineer their balance sheets and their assets and their stock to buy more Bitcoin. To me, that's adding on additional risk and leverage, and I can't quite understand why they're trading at such a premium to the net asset value. There's also Bitcoin balance sheet companies, what I call them, and those are companies that are like Tesla and Square in the last Bitcoin cycle, who simply are taking 5 or 10% of their cash and putting it into Bitcoin as a hedge against inflation and to protect against that cash being devalued. To me, that's a much safer bet. That's how an individual should approach Bitcoin in their portfolio as well. You just want to own some. It has idiosyncratic risk. It behaves differently than other assets, and it's a great hedge. Financially engineering a balance sheet, to me, looks like it's the beginning of the next bubble. I'm not going to say we're at the end of that bubble by any chance. I think we're at the beginning. But I think that at the end of this bull market or this particular rally in a few months, those are going to be the people that are puking up their Bitcoin because they've entered too late or have done poor financial engineering and are forced to sell.
Scott, always great to see you and to have you on the show. Thank you.
Thank you.
Meta is going all in on artificial intelligence. CEO Mark Zuckerberg saying the company plans to invest hundreds of billions of dollars to build AI infrastructure, the physical backbone behind AI advancement, including some of the largest data center clusters ever attempted. Will the spend on superintelligence pay off? Tech editor Dan Howard joins us now. Dan.
Yeah, Josh, these are some big moves that Meta is undertaking. Two of the data centers that they discussed, one was Prometheus. That's a 1 gigawatt data center. The other is going to be upwards of 5 gigawatts. So just to give you an example, a gigawatt is a billion watts. The estimate is that can run up to 800,000 homes over the course of a year. So the amount of power that these are pulling is absolutely incredible. And part of the effort here is to build up Meta's superintelligence lab. And the thinking is to develop an AI that kind of exceeds human intelligence. They're also obviously using these to train their own AIs, their Llama AIs, and then that being used in their advertising efforts, as well as their recommendation engine efforts. And so this is all part of the kind of long-term Meta strategy as they push forward into AI. And it's worth pointing out that in addition to those kind of capabilities, the AI will also be used as part of Meta's push into the kind of augmented reality space, where they have, augmented reality glasses and things of that nature. So it's going to encompass all of its products, but this build out is just going to be absolutely incredible. I mean, one of the size of one of the labs kind of takes up a large portion of Manhattan when overlaid on it. So just to give you an example, I mean, that's the size of the Hyperion is the second data center that they're working on. And so that's how large it's going to be. So it'll be interesting to see, when these are fully built, what they have to offer, what the impact will be of these. Obviously, they're huge, resource intensive data centers. And so, we'll just have to see where this kind of leads for Meta.
Dan, obviously Meta, as you know, this has a lot of fans on the street, right? And those bulls will often, Dan, they'll make the argument that this is a company where AI investments are paying off. And they'll point to user time and advertiser spend. And I'm just interested in what you make of that argument.
Yeah, I mean, look, it makes sense, right? For Meta, they've specifically pointed towards how their advertising customers are using their AI offerings when it comes to building out, smaller parts of ad campaigns, things like that, to make it easier for the smaller advertisers, the smaller customers, to get their products out there. And that's really the backbone of Meta. It's the small advertisers, not the massive companies, but the smaller companies that really make up the bulk of its advertising revenue. And so getting those kinds of technologies and capabilities out there so they can get their products out there will eventually help them, and has helped them so far. And then as far as you pointed to longer user time, I mean, they're seeing that with the recommendations engines that they've kind of helped to build up, and Reels obviously pulling more people in. So it seems to be working. This seems to be the kind of poster child for where the AI investments start to pay off. We're obviously seeing it in Google and Amazon and Microsoft as well, although they're more focused, Microsoft, on the enterprise side of things. They do have advertising, but when it comes to Meta, it's really that advertising, that user kind of dwell time that really is getting kind of the play and showing that this is starting to pay off.
Dan, thank you, sir. Coming up, shares of Procter & Gamble Company taking a hit today on the back of a bearish analyst note. We're checking on some of the top calls of the day on the other side. Stick around. Much more market domination still to come. Now time for some of our top calls of the day, starting off with Procter & Gamble, taking a hit today after Evercore ISA downgraded that one to an inline from outperform and lowered its price target to 170 down from 190, citing rising risk of competition from Amazon and concerns over Procter's growth potential. So this one, they go to inline, Tom, so they're basically a hold, right? Yep. Concern increasing lies in advertiser shifts in retail channels that challenge the company's potential. They see this shift to online as structural and one that is difficult to address under Procter's current organization, at least in the short term.
Yeah, they'll figure it out. They've got brand moats, but the problem is it's got low single-digit growth and is trading at mid-20s multiple forward earnings, so it's a little bit ahead of itself. I will say a lot of the defensives have been beaten down. Procter is not one of them. So for me to put new money to work on this downgrade, it's not that attractive in terms of price is what you pay, value is what you get. I think that it will recover, it will be fine, but it's kind of already priced out in at these levels, so I'm a pass on that.
A pass on that. Let's check in on another one. That'd be shares of Rivian, riding lower today on the back of a downgrade, a neutral from buy at Guggenheim, who also removed its price target on the EV maker. The analysts there saying the EV incentive changes have both near and long-term implications. So Guggenheim downgrades this one to neutral. They talk about, Tom, softer long-term R2, R3 assumptions driven by both softer R1 sales. They talk about negative U.S. EV and emission policy changes. How do you see this one?
I wouldn't buy this with your money.
Wow, that doesn't sound bullish.
I'll tell you, look, I think at the end of the day, it's going to be Tesla and the rest as it relates to the EV world. And Rivian's just not part of that equation. Yes, if you're in the Hamptons and you don't want to drive around in a Tesla, you're driving around in a Rivian, but they haven't changed the model. They got the model right originally, but it's getting a little stale, and I don't think they've got the money for the refresh. EV incentives going away, subsidized market going away in the US, too much competition with China if they want to be outside of the US. Not a good outlook.
They say we no longer have confidence in the required volumes and or required ASPs to support our prior price target, referring there to average selling price. The stock is down about 5% this year, but most on the street, it looks like Guggenheim, they're most are at a hold here. All right, finally, Melius Research initiating coverage on Starbucks with a sell rating and an $80 target price, implying 16% downside from the current price. Melius pointing out the competitive intensity that Starbucks faces. So, you don't a lot of times initiating a sell, you don't find that very often, but they go out there with this. They say avoid this one.
Of these three, this would be the one that I hope they keep downgrading so I can buy some shares.
Why?
It's a high quality business, durable moat, every corner, predictability, all the factors you want in a durable, growing business. Yes, they've had competition abroad, they've had competition here, they had some bad execution, but at the end of the day, every time I pass a Starbucks, the 11-year-old and 13-year-old daughter want to stop. So,
let me ask you this, turnaround time. Here's how they put it, right? They say, listen, they acknowledge coffee leader, global coffee leader, they said, but the road to operational consistency, brand revitalization, longer and harder than consensus expects. A turnaround, they said, is underway, but not yet proven, and execution risk is high on this one.
I like that, and I like it lower. I wouldn't be a buyer here, but if they keep downgrading it on the sell side for another few months, it's going to get low enough that I'm going to get interested.
All right. We'll have you back when you do. And Tom, you know Starbucks currently undergoing a turnaround strategy, as we were just discussing. In the world of turnaround stories, Tom, you're looking at certain plays that you deem it worth keeping an eye on. So let's go through some of those.
Well, these are all the companies that we own. I mean, we came out publicly talking lately about Advanced Auto Parts. Okay, This is something that you couldn't give away just a couple of months ago. Got hammered on the tariffs. Well, first off, it got hammered on COVID, overstock, destock, poorly run. O'Reilly ate their lunch, stock down 80-something%. So we started building a position, and we like this because we bet on jockeys with turnarounds. So Shane O'Kelly came from HD Supply, $7 billion business. He sold off the Canada business, delevered the balance sheet, closed the unprofitable stores on the West Coast that were too spread out so they couldn't get economies of scale. And now he's cleaned up the mess, and he's back into expansion, opening 100 new stores in the next 3 years, all in markets where they are number one and number two, so that they can consolidate distribution centers, serve the customer faster, and it's already working. This thing's already doubled from 30 to 60. By the way, he's targeting high single-digit margins by the end of 2027, early 2028. Last time they had those margins, the stock traded at 150. It's still only at 60.
As you noted, there's been a nice move in the stock. I'm just wondering, it is now up about 30% this year, but you're obviously saying valuation is still attractive.
This thing just getting started. If it pulls back $5, I'd be a buyer here if you don't have a position. But Shane O'Kelly has a proven track record. He knows exactly what he's doing, and he's doing everything he said he was going to do just in the short while that he's taken the helm, and very, very, very promising for the plan. And the last one is a brand new one, which is National, well, it used to be called National Oil Well Varco. And the reason I'm bringing that up for NOV Inc. is because it's the cheapest it's been since back when it was called that in 2001 through 2007. It was at these levels right before it had a 10-bagger. So this is a...
And why is it cheap, Tom?
Yeah, well, it's cheap because, number one, they got flushed out after 2018 with all the fracking, et cetera. The demand for rigs, technology's gotten better. However, I think we're at a point with positive energy policy. As rates come down, it will become economic to drill more at lower prices, and they're going to be the beneficiary. They've got, they're an OEM of onshore and offshoring drilling rigs. They have the highest install base. They've got 50% share, and it's trading like it's gone out of business. It's not going out of business. They generated over $1 billion of free cash flow last year. They got a great balance sheet, billion plus of cash, billion of debt. And so if you believe that we're going to, energy policy is going to be favorable the next few years, we're going to have more production, they're going to be great beneficiaries, and they've got the largest install base for the aftermarket servicing. So even if you get fluctuations in energy price at these levels with that install base, they're going to be less affected. And if you get any positive outcome in drill rigs increasing, which we're kind of at a trough right now, that's why I like to buy things. We talked about Albemarle last time, that's moved up 20 points since. Then this is a safer way to play it in terms of good balance sheet, less price risk than buying, oil and gas type of company. They're kind of picks and shovels, and I like picks and shovels plays versus being fully at the effect of the underlying commodity price.
Can I just ask you about the drill baby drill mantra?
Yeah.
Because I've had any number of very smart energy analysts come out of it. And I always ask them about it. And I don't think I've yet to find one who says it's going to happen. They all tell me, Josh, I realize it's a Trump mantra. It's a GOP mantra. It's not going to happen, not with WTI at these levels.
Yeah, well, you have to look at the equation. So if Trump is effective in either announcing a shadow Fed or the Fed actually cuts 2-3 times this year and rates go lower, the economics of that decision and the planning become completely different. But when you have rates up here, why would you drill at $60? But if your cost of capital comes down by a third, if rates come down, 150 basis points, 125 basis points, you can drill profitably at 65, and that's what they're here to do. And by the way, in the meantime, you get a 4.1% dividend yield while you wait. So I like it at these levels because my downside is pretty well protected because they got a healthy balance sheet. They're free cash flow generative, and my upside, if we catch a cycle like we did in the early 2000s, and I think there are a lot of similarities to that cycle as it relates to commodities, weaker dollar, et cetera, and economic growth, that this thing could be a multi-bagger over the next 3 to 5 years.
I want to end on one final name, Canada Goose. Explain why that one's a buy them.
Okay. You're not going to believe it. Stock's still down 80%. It was one of these COVID stories. They overstocked, blah, blah, blah. Okay. They've got record free cash flow, record revenues, record margins. Stock is still down 80% off the COVID peaks. Okay, so I play these divergences. Family-run business, second generation. They own 39.5% of the stock. They're turning around. Here's how they're doing it. Cutting out the wholesale business, which was low margin, going DTC, 74 beautiful stores. You know the one on Fifth Avenue. Those margins are up. Margins are up to 71%, and it's no longer just parkas. Drake is yesterday's news. He used to wear it. They've got raincoats, they've got eyewear, they've got footwear, they've got T-shirts, and it's affordable. So it's not just the people that can afford a $900 or $1,500 jacket. It's someone that says, I want a Canada Goose T-shirt for $50. I want the hat for $75, and it becomes affordable luxury like some of the other brands. You go into Tiffany's, you got stuff at, $500,000, and you have stuff at $300. You can get a bracelet for your daughter.
You mentioned the stock. I mean, relative COVID. It has, though, more recently this year. It's had a nice pop already. Yeah. You say stick with it, though, Tom.
Yeah. Look, I mean, we've got a much lower basis, but this is early days. I mean, the stock was up again, down 80%, and now cash flow is higher than it was at those levels. So when you play those divergences, in the short term, the market is a voting machine based on emotions. That's what you're seeing right now. It's left for dead. In the long term, it's a weighing machine based on fundamentals. Fundamentals are better than they've ever been. Price is worse than it's ever been. Bet on price. It'll catch up to fundamentals as they keep growing.
You made a very compelling case. If I'm a viewer, I'm listening, before I carve out a position.
Yep.
You always think through downside risks. I know that.
100%.
What are they here?
Yeah, look, the balance sheet is pretty clean. The one risk, obviously, there's some uncertainty about tariffs. They're Canadian-based, but they have much less impact. Management went through it on the last earnings call. Listen to some of the earnings calls. You'll be less concerned about tariffs. I think if you had a consumer week, but we saw Bank of America credit card spending up big in June, now that certainty's coming back after the April-May uncertainty. So I think on balance, you want to be exposed to some of these brands, and I like the fact consumer discretionary, no one wants it. It was an underperformer first half. Second half, it's starting to outperform, and I want to be in those that are now, you're seeing it the first 3 weeks already, that rotation. The Gooses of the world, Advanced Auto Parts kind of qualifies in somewhat in that discretionary, and others like Starbucks to a lesser extent, the Nikes of the world. We don't own Nike, we don't own Starbucks. But I like those themes where people were counting them out. They were going to get killed by tariffs and uncertainty, and now they're roaring back, and the prices have not reflected that. And that's where all these people that got caught flat-footed in April in the hole, selling in the hole, now they have to catch up. They can't catch up by buying Meta up huge or Nvidia up huge. They got to catch up by buying the laggards that have good fundamentals, so hopefully they can catch up to the indices if they sold at the wrong time. So these type of names are going to outperform in the second half, and that's where we're placing our bets.
All right, 3 picks from Turnaround Tom. Thank you, sir. While wrapping up today's Market Domination, don't go anywhere. We've got you covered with all the action. Following the closing bell, stay tuned for Market Domination Overtime.